Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
International Paper was incorporated in 1898 from the consolidation of 17 northeastern pulp and paper mills. Today, it is one of the world's largest paper and packaging companies by total global revenue.
CEO Andy Silvernail took over in 2024, coming from IDEX Corporation, where he built a strong record of operational discipline and margin improvement. He then launched a comprehensive transformation at International Paper.
The DS Smith acquisition for $9.9 billion, completed in 2024, adds a major European corrugated packaging business with strong positions across the UK and continental European packaging markets.
The combined Americas and EMEA structure generates approximately $22 billion in annual revenue, with scale enabling significant procurement leverage, mill optimization, and comprehensive global customer relationship management programs across regions.
Vertical integration from pulpwood forestry through corrugated box manufacturing is the core structural competitive moat. Owning the raw material supply chain allows cost and quality management that pure converters simply cannot achieve.
Containerboard pricing is inherently cyclical, correlating closely with both industrial and consumer goods production volumes. When the economy weakens and inventories build, box demand softens and mill utilization rates decline meaningfully.
The transformation plan targets meaningful margin improvement through mill footprint optimization, significant overhead cost reduction, and thoroughly disciplined commercial pricing across both the Americas and the European EMEA segment operations broadly.
Containerboard pricing is determined through published industry price indices and negotiated customer contracts. International Paper's scale provides meaningful market influence in North American containerboard during periods of supply and demand balance.
E-commerce structural demand is a durable and growing tailwind for corrugated packaging volumes. Online retail consistently requires significantly more packaging per transaction than traditional retail shelf stocking and physical distribution replenishment methods.
Smurfit Westrock is now the most direct global competitor following their own combination. Packaging Corp of America remains the closest North American rival on containerboard mill economics and regional market pricing.
The near-term focus is integration execution. Can Silvernail's team capture the DS Smith synergies, reduce its legacy cost structure, and deliver the earnings improvement the deal was premised upon?
The dividend has historically been central to the IP story. The company has maintained a consistent payout through containerboard price cycles, reflecting the underlying long-term stability of its core asset base.
The longer-term thesis rests on secular e-commerce demand growth, the transformation program's margin expansion potential, and the scale advantages from being among the global leaders in containerboard production.
For materials sector investors, International Paper offers scale, vertical integration, e-commerce demand tailwinds, and a management team with a credible track record of operational improvement and margin delivery in prior senior roles.
That's the company chapter for International Paper. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
International Paper just dropped Q1 earnings, and the headline number missed estimates. But the real story here is what's happening inside a company that just doubled in size. We're talking about the DS Smith acquisition, a global packaging empire in the making, and whether CEO Andrew Silvernail can deliver the synergies that justify this enormous bet. Let's get into it.
International Paper is one of the world's largest packaging and paper companies, headquartered in Memphis, Tennessee. With 65,000 employees globally, IP produces containerboard, corrugated packaging, and industrial packaging used across consumer goods, e-commerce, food distribution, and retail industries. It serves customers across North America, Europe, and growing markets worldwide.
The defining event is the acquisition of DS Smith, a major UK packaging company, which closed in 2025 and transformed IP into a truly global containerboard leader. TTM revenue jumped 33.7% year over year to nearly $25 billion. IP is a fundamentally different and much larger company than it was 18 months ago, and the market is still figuring out what it's worth.
Q1 2026 revenue came in at $6.02 billion, essentially in line with consensus estimates. But EPS was 15 cents versus an 18-cent estimate, a 16.7% miss. The shortfall reflects ongoing integration costs from the DS Smith combination flowing through the income statement this quarter.
On a TTM basis, revenue is $24.9 billion. Net income is deeply negative at around negative $3.5 billion, but that's almost entirely driven by a $2.4 billion write-off recorded in Q4 2025 tied to DS Smith acquisition charges and impairments. On an adjusted operating basis, earnings remain solidly positive and growing.
The balance sheet shows the weight of this deal. Cash stands at $1.1 billion, but total debt is $10.8 billion. Total equity is $14.8 billion, and total assets are $38 billion. Leverage is elevated but manageable given the combined asset base and the cash generation profile of the integrated company.
Operating cash flow on a TTM basis is $1.7 billion. Capital expenditures ran $1.9 billion, pushing free cash flow to negative $159 million. That negative FCF reflects heavy integration investment. It is expected to normalize meaningfully as synergies kick in, and the elevated CapEx program tapers over the next 2 years.
The market cap sits around $16.8 billion at a stock price near $55. The reported PE is 91.7 times, obviously distorted by those acquisition write-offs and charges. On an adjusted basis, the earnings multiple is far more reasonable, and that adjusted figure is the one Wall Street is actually using to value the stock.
The synergy target is $514 million annually from the DS Smith deal. Management has outlined the path clearly. Cost efficiencies in procurement, logistics, and shared manufacturing infrastructure are the primary levers. If Silvernail delivers even 75% of that target within 3 years, the EPS normalization story becomes very compelling at this price.
Street consensus on IP is cautiously optimistic. Most analysts have a hold-to-buy range on the stock, acknowledging the integration risk while recognizing that the synergy opportunity is real. The Q1 miss has not dramatically shifted sentiment because everyone expected near-term noise from the combination.
The bull thesis from the street is simple. If IP delivers on $514 million in synergies over 2 to 3 years, EPS normalizes well above $2 per share. At that level, the stock trading near 55 looks cheap. Several analysts have price targets in the $65 to $75 range.
The bear case from skeptics centers on execution. DS Smith brought European exposure, and European containerboard has been in oversupply. If volumes stay soft on that side of the Atlantic and integration costs linger, the synergy timeline slips. Debt servicing at $10.8 billion is a real drag in a high-rate environment.
E-commerce is the macro driver here. Containerboard demand is tied directly to parcel shipments, and that trend is secular. Amazon, Walmart, and every major retailer are shipping more boxes than ever. IP's scale across North America and Europe positions it well if that demand continues compounding.
Analysts are also watching commodity pricing, specifically old corrugated containers and recycled fiber input costs. When those input costs rise, margins compress. The export market dynamic matters too, as European packaging capacity affects global pricing. Investors will be watching IP's price realization commentary closely each quarter.
The bull case starts with scale. IP plus DS Smith is now one of the largest containerboard companies on the planet. Global scale means purchasing power, cross-selling opportunities, and the ability to serve multinational consumer goods clients from a single supplier relationship. That has real value.
Synergy execution is the core catalyst. The $514 million target is not heroic. It's achievable through procurement savings, shared infrastructure, and eliminating redundant overhead. If management hits it over 3 years, the earnings power of this company looks very different by 2028.
E-commerce packaging demand is a long-cycle tailwind. Every percentage point of retail that shifts online requires more corrugated boxes. IP is the pick-and-shovel play on that structural trend. Add in food and consumer staples packaging demand, and you have a diversified, essential business with pricing power.
Integration risk is the primary concern. DS Smith was a large, complex business operating across multiple European jurisdictions with different labor laws, customer relationships, and operational systems. Merging that into IP's existing structure without losing customers or talent is not a trivial undertaking.
The debt load is real. $10.8 billion in debt at current interest rates is a meaningful drag on earnings. With FCF currently negative, IP is not generating enough cash to deleverage organically. A sustained period of packaging weakness could pressure the balance sheet in ways the market hasn't fully priced.
European packaging oversupply is a structural headwind that doesn't resolve quickly. Too much capacity exists across the continent, which pressures prices and margins. DS Smith's European operations face this environment directly. Until capacity rationalization happens, that side of the business will be a drag.
Commodity price volatility cuts both ways. When recycled fiber and energy costs spike, margins compress. IP has some ability to pass through costs with pricing, but there's always a lag. In a recessionary environment, packaging volumes could also soften, and with high fixed costs in this business, volume drops hurt fast.
IP's closest direct peer is Smurfit Westrock, which formed from the Smurfit Kappa and Westrock merger in 2024. SW trades around $50 with a market cap near $21 billion, very comparable to IP. Both are going through major integration phases, and both are betting on containerboard demand growth.
Packaging Corporation of America, PKG, is a cleaner comparison in some ways. It's a pure-play North American containerboard producer with no major integration overhang. PKG tends to trade at a premium to IP on a valuation basis because of its operational simplicity and strong free cash flow generation.
Before the DS Smith acquisition, Mondi and Smurfit Kappa were IP's European counterparts. Now that IP owns DS Smith and SW has absorbed Westrock, the containerboard landscape has consolidated dramatically. Fewer major players means better long-term pricing discipline if demand holds up.
The key differentiation for IP versus peers is its global footprint post-acquisition. Neither PKG nor most North American peers have meaningful European manufacturing. That global reach is a strategic advantage for serving multinational customers, but also a source of complexity that peers don't have to manage.
Options activity around IP has reflected uncertainty. Implied volatility is elevated relative to historical norms, consistent with a stock going through a major integration. Traders have been buying protection against downside while the synergy story plays out. The options market is pricing in wider than normal quarterly moves.
Insider activity is worth watching for a signal on management's confidence. CEO Andrew Silvernail has been vocal about the DS Smith opportunity in public forums. Any meaningful open market purchases by executives at these levels would be a strong signal of conviction. Watch the Form 4 filings coming out of Memphis over the next quarter.
Institutional positioning shows a mixed picture. Value-oriented funds have been accumulating IP on the thesis that adjusted earnings will normalize post-integration. Growth funds are largely on the sidelines given the negative reported net income and integration noise. The stock needs a clean quarter or two to attract broader institutional buying.
The stock has underperformed the S&P this year, which has created what some investors view as an entry point. The real catalyst watch, any pre-announcement of synergy progress ahead of Q2 earnings or an upward revision to the $514 million target. Either would be a significant positive surprise for the market.
International paper is a show-me story right now. The DS Smith deal is transformative, the synergy opportunity is real, and e-commerce packaging is a long-cycle tailwind. But elevated debt and integration complexity mean execution risk is high.
If Silvernail delivers on synergies, this stock is cheap at 55. If integration falters, the debt load becomes a problem. It's a compelling risk-reward for patient, value-oriented investors willing to ride out near-term noise. Keep it on your watch list.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.